Stop picking stocks and use ETFs instead. You open your investing app for the first time, and it hits you. Thousands of funds, weird ticker symbols, lines flying up and down like a heart monitor. And your brain goes, wait, am I supposed to understand all this before I even start? Here's the truth almost nobody tells beginners. You don't need to predict the market. You don't need to find the next Tesla or Nvidia. And you definitely don't need to spend 10 hours a week researching individual stocks. You really just need to understand one simple tool that completely changed the game for regular investors: ETFs, exchange-traded funds. Once you understand the types of ETFs and what job each type does, investing stops feeling like gambling and starts feeling like a quiet little system working in the background while you live your life. In this video, I'll walk you through the 8 major types of ETFs. Real ETF examples for each category. How a 25-year-old and a 55-year-old might use them differently. The biggest beginner mistakes to avoid. And finally, how to turn all of this into one simple beginner-friendly portfolio you can actually implement. Stay with me to the end, because I'll show you a core and satellite ETF setup you can literally sketch on a napkin and reuse for decades. Let's make investing plain and simple. What is an ETF really? ETF stands for Exchange Traded Fund. Think of an ETF as a pre-built basket of investments you can buy with a single click. Instead of buying one stock at a time, Apple, Microsoft, Amazon, an ETF might hold hundreds or even thousands of stocks, bonds, or other assets inside that single ticker symbol. It trades on an exchange just like a stock, so you can buy and sell it throughout the day. On your screen, it just looks like one line item. Under the hood, it's instant diversification, professional structure, and in many cases, very low fees. Compared with many mutual funds, ETFs typically offer lower expense ratios, intraday trading, you're not stuck with end-of-day pricing, and a structure that can be more tax efficient thanks to what's called in-kind creation and redemption. We'll keep it practical. You don't need to be a tax lawyer to use ETFs. You just need to know which type of ETF belongs where in your plan. Quick pause right here. If you are getting value out of this video so far, please take a second to hit that like button and subscribe to the channel. It really helps the channel grow and signals to the YouTube algorithm to push this content out to more people who need it. And if you know someone else who could use a little help on their own investing journey, definitely share this video with them. All right, let's get back into it. So let's go through the big categories one by one. First, equity, stock ETFs, your growth engine. Equity or stock ETFs are the growth engine of most portfolios. They hold baskets of stocks and usually track a broad index, a region, or a sector. These are the funds most people are talking about when you hear the market. What they are: an equity ETF might track a broad market like the S&P 500, the entire U.S. stock market, international stocks, or a specific slice like large cap growth or small cap value. Concrete examples: SPDR, S, and P500 ETF Trust, ticker SPY, tracks 500 large U.S. companies. Vanguard Total Stock Market ETF, VTI, covers almost the entire U.S. market, thousands of stocks. Invesco QQQ Trust, QQQ, tracks the NASDAQ 100, which is very heavy on big tech and growth names. Historically, broad U.S. stock ETFs like SPY have delivered roughly around 9 to 10% annualized over long periods, but with big ups and downs along the way. Some years you might see gains of 25%, other years drop of 30%. In the short term, stock ETFs are an emotional roller coaster. Over decades, that roller coaster has tilted upward. At 25, your main risk is not market volatility, it's not investing early enough. A 25-year-old might be perfectly fine with 80 to 90% of their portfolio in broad equity ETFs like VTI or SPY because they have time to ride out the drops. At 55, yes, you still need growth to fight inflation, but you can't afford to see your entire nest egg cut in half right before retirement. A 55-year-old might dial back to something like 60 to 70% in equity ETFs and balance the rest with bonds. Bottom line, stock ETFs are usually the core of your long-term growth strategy, but you have to be comfortable with volatility and commit to staying invested through the rough patches. Number 2 on our list of ETFs are fixed income, bond ETFs, your shock absorbers. Bond ETFs are like the shock absorbers of your portfolio. Instead of owning companies, they own bonds, IOUs issued by governments, corporations, or municipalities. Their main job isn't massive growth, it's income and stability. A bond ETF collects many different bonds into one fund, spreading your risk across issuers, sectors, and maturities. iShares Core U.S. Aggregate Bond ETF, AGG, a broad mix of U.S. investment-grade bonds. Vanguard Total Bond Market ETF, BND, another widely used core bond holding. Both are designed to be boring in a good way. In a stock market crash where stocks fall 30%, a diversified bond ETF might only drop a few percent or even hold steady, depending on the environment. Over time, bond ETFs tend to return less than stocks. AGG's long-term annualized return has been just over 3% since 2003, but with a much smoother ride. They help you stay invested by reducing the emotional swings in your overall portfolio. At 25, you might only use 5 to 15% in bond ETFs, just enough to take the edge off volatility. At 55 or approaching retirement, you might have 40 to 60% in bond ETFs, like AGG or BND, to protect against large drawdowns. Bottom line, bond ETFs trade some growth for stability and income. They're essential for balancing risk, especially as you get closer to needing your money. Number 3 on our list of types of ETFs are commodity ETFs, inflation hedges, and diversifiers. Commodity ETFs give you exposure to physical resources like gold, silver, oil, or even agricultural products. Some hold the physical commodity, like bars of gold in a vault. Others use futures contracts to track the price. SPDR Gold Shares, GLD, aims to track the price of gold bullion. iShares Silver Trust, SLV, gives exposure to silver prices. Invesco DB Commodity Index Tracking Fund, DBC, a basket of multiple commodities. Commodities often zig when stocks zag. When inflation is high and currencies are losing purchasing power, gold and other commodities sometimes hold value better than stocks or bonds. But here's the catch. Commodities don't produce earnings like companies or pay regular interest like bonds. Your return depends heavily on price changes, and futures-based products can suffer from issues like contango, which quietly drags on returns over time. Who might use them? A retiree worried about inflation might allocate 5 to 10% to a gold ETF like GLD as a hedge. A younger investor might use a small commodity slice as diversification, but shouldn't rely on it as the main growth engine. Bottom line, commodity ETFs can be powerful diversifiers and potential inflation hedges. But for most people, they're a small slice, not the core of a portfolio. Number 4 on the list of types of ETFs are currency ETFs, niche but useful tools. Currency ETFs track the value of a currency, or a basket of currencies, versus another, often the US dollar. Instead of opening a Forex account, you can buy an ETF that reflects moves in, say, the euro or Japanese yen. Forex, or foreign exchange, FX, is the global, decentralized, over-the-counter market for trading national currencies against one another. Invesco Currency Shares Euro Trust, FXE, tracks the euro versus the US dollar. Invesco Currency Shares Japanese Yen Trust, FXY, tracks the yen. Currency markets can be volatile and are notoriously hard to predict. These ETFs are often used by businesses hedging foreign revenue, investors who want to tactically bet on a currency move, or people trying to reduce exchange rate risk in international portfolios. Bottom line, for most long-term individual investors, currency ETFs are tactical tools, not core building blocks. They're interesting, but not where beginners should focus. Number 5 on the list of types of ETFs are multi-asset or allocation ETFs, set-and-forget portfolios. Allocation ETFs mix stocks and bonds, and sometimes other assets, inside a single fund with a target percentage, like 60% stocks, 40% bonds. Think of them as a complete portfolio in one ticker. They also typically rebalance automatically to maintain the target mix. Vanguard Balanced Index Fund ETF shares, VBIX and VBIX, mutual ETF structure varies, style strategy often mirrored by similar 60/40 ETFs. Many providers also offer named 60/40 or 40/60 allocation ETFs that hold a mix of equity and bond ETFs inside. If stocks rally and your 60/40 ETF drifts up to 70/30, the fund will periodically sell some stocks and buy bonds to rebalance back to 60/40. Who might use them? Busy professionals who want true simplicity, one fund, automatic rebalancing, globally diversified. Beginners who are afraid of messing up the stock-to-bond split. Pros: one trade diversification, built-in rebalancing, clear risk profile based on the stock-bond mix. Cons: you give up fine-tuned control over your exact allocation. Fees can be slightly higher than buying two basic ETFs yourself. Bottom line, allocation ETFs are fantastic for set-and-forget investors who value simplicity over micromanaging every position. Number 6 on the list of types of ETFs are smart beta or factor ETFs, fine-tuning the engine. Smart beta or factor ETFs don't just weight companies by size. Instead, they tilt towards specific factors like value, quality, low volatility, momentum, or high dividends. They follow rules-based indexes designed to capture traits that research suggests have been rewarded over long periods. iShares MSCI USA Quality Factor ETF QAUL focuses on companies with strong profitability and balance sheets. Vanguard High Dividend Yield ETF VIM emphasizes higher dividend-paying stocks. iShares Edge MSCI MinVol USA ETF USMV targets stocks with historically lower volatility. These ETFs can outperform or underperform the broad market for long stretches depending on where we are in the market cycle. For example, a value or high dividend ETF might lag during a hot tech-driven bull market but hold up better in choppier times. Who might use them? Investors with a solid core in broad ETFs who want to tilt towards income, quality, or other factors. Retirees using dividend ETFs to generate more regular cash flow. Bottom line, factor ETFs are portfolio enhancers, not replacements for a broad core. They're best added after your main foundation is already in place. Number 7 on the list of types of ETFs are thematic and sector ETFs, trendy but risky satellites. Thematic and sector ETFs zoom in on specific industries or big themes. You can buy ETFs that focus on technology, healthcare, utilities, clean energy, cybersecurity, robotics, artificial intelligence, and plenty more. Technology Select Sector SPDR Fund XLK US Tech Sector. Healthcare Select Sector SPDR Fund XLV Healthcare Sector. iShares Global Clean Energy ETF ICLN Clean Energy Theme. Global X Robotics and Artificial Intelligence ETF BOTZ Robotics and AI. Picture a clean energy ETF that doubles in one euphoric year and then drops 40% the next when the hype fades. That's typical sector/thematic behavior: higher volatility, faster boom and bust cycles, more concentrated risk. Young investors often get excited about these trends and accidentally build portfolios that are 80% theme and 20% boring diversified core. That's backwards. Bottom line, thematic and sector ETFs are satellites, not the main dish. Use them sparingly around a diversified core. Think 5 to 10% slices, not your whole portfolio. Finally, number 8 on the list of types of ETFs are leveraged and inverse ETFs, advanced only. Leveraged and inverse ETFs are like power tools, incredibly effective in skilled hands, very dangerous in the wrong context. Leveraged ETFs aim to deliver 2x or 3x the daily return of an index. Inverse ETFs aim to move in the opposite direction. For example, go up when the S&P 500 goes down. ProShares Ultra Pro QQQ TQQQ targets 3 times the daily return of the NASDAQ 100. ProShares Ultra Short S&P 500 SDS targets -2 times the daily return of the S&P 500. These are designed for short-term trading, not long-term buy and hold. Because they reset daily, compounding can cause their long-term performance to drift far away from what you'd expect if you just multiplied the index's return. Losses can compound quickly in volatile markets. Bottom line, these products are built for experienced traders managing very specific bets or hedges. For most beginners and long-term investors, they're best avoided. How ETFs actually work, why they're so efficient. Let's zoom out for a minute and talk about why ETFs are such a powerful structure. In-kind creation and tax efficiency. When big institutions create or redeem ETF shares, they usually swap baskets of underlying securities instead of forcing the fund to sell holdings for cash. That process helps minimize capital gains distributions to investors, making many ETFs more tax efficient than traditional mutual funds. Dividends and income. If your ETF holds dividend-paying stocks or interest-bearing bonds, it collects that income and typically pays it out monthly or quarterly. Most brokers will let you automatically reinvest those dividends into more shares, which quietly accelerates your long-term compounding. Active versus passive. Passive ETFs track an index like the S&P 500 or a total market index. Their goal is to match the market, not beat it, which keeps costs low. Active ETFs have managers choosing securities in an attempt to outperform. Fees are higher and results can vary widely. For most beginners, low-cost passive ETFs are a clean, straightforward starting point. Common beginner ETF mistakes. Before we build your actual portfolio, let's quickly hit the traps I see all the time. Chasing last year's hottest ETF, buying the fund that just skyrocketed, is often like showing up to a party when the music is already fading. Many thematic funds peak before most people hear about them. Owning 10 ETFs that all own the same stuff. If you buy 3 different total U.S. market ETFs, you haven't diversified. You've just duplicated your holdings and maybe your fees. Ignoring the expense ratio, even a 1% difference in annual fees can cost you tens of thousands over decades. Many broad index ETFs charge under 0.10%, while niche or active funds can be 0.50% or more. Overloading on themes and sectors. Having 70% of your money in clean energy, AI, and biotech ETFs is not diversification. That's just concentrated risk with fancy tickers. Panic selling during downturns. The ETF itself isn't the problem. Behavior is. The market drops, emotions spike, people sell at the bottom, then watch the recovery from the sidelines. Believing complexity equals intelligence. You don't get bonus points for having 14 ETFs and a flowchart. Some of the most successful investors on earth use simple, boring, diversified portfolios. Step by step, building a simple ETF portfolio. Let's put all this together into something you can actually use. We'll use a classic core and satellite approach. Step 1, choose your core equity ETF. This is your main growth engine. Usually 70 to 90% of the portfolio for younger investors, less as you approach retirement. Examples include U.S. Total Market, VTI, S&P 500, SPY or VOO or similar low-cost S&P 500 ETF. If you want international exposure, you might add a global ex-US ETF as part of the core. For a beginner, starting with just one broad low-cost U.S. equity ETF is absolutely fine. Step 2. Add a core bond ETF. Now we add the shock absorbers. Broad U.S. bond ETF like AGG or BND. Adjust the percentage based on your age and risk tolerance. A rough glide path might look like around 25 years old, 80 to 90% stock ETFs, 2 to 20% bond ETFs. Around 40 years old, maybe 70% stock, 30% bonds. Near retirement, 40 to 60% stocks, 40 to 60% bonds, depending on your risk comfort and income needs. Step 3. Add small diversifiers, optional. Once your core is set, you can sprinkle in 5-10% in a commodity ETF like GLD or a broad commodity basket for inflation hedging, 5-15% in factor ETFs like a high dividend ETF or a quality factor ETF to tilt towards specific characteristics, small slices in sector or thematic ETFs you really believe in, like clean energy, ICLN, or robotics, BOTZ, capped at maybe 5% each. These are your satellites, not your foundation. Step 4. Rebalance once a year. Once or twice a year, check your percentages. If stocks had a huge run and your 70-30 portfolio is now 80-20, you sell a little of the winners and buy the laggards to get back to your target mix. It feels weird at first, selling what just did well and buying what lagged, but that's exactly how you systematically buy low, sell high. Here's the real secret most people never learn. The biggest investing mistake usually isn't picking the wrong ETF. It's never starting or giving up when things get scary. ETFs gave everyday investors access to what used to be institutional-only tools: instant diversification, low fees, market-level returns, the ability to build a plan that runs quietly in the background while you focus on your life. You don't need a finance degree. You don't need to watch the market every day. You need a simple plan, a handful of well-chosen ETF types, and the discipline to stick with it through good times and bad. So here's your action step. Pick one broad equity ETF for your core. Add a bond ETF for stability. Decide on a stock-to-bond mix that fits your age and risk tolerance. If you want, sprinkle in a few small satellites, commodities, factors, or a favorite theme. Automate your contributions and rebalance once a year. If you found this helpful and want more plain English breakdowns on ETFs, portfolios, and long-term investing, make sure you hit like, subscribe, and drop a comment telling me your age and what ETF you're considering for your core. I'll see you in the next video. Until then, remember, investing doesn't have to be complicated. It just has to be plain and simple.